The COVID-19 crisis has engendered one of the most dramatic reversals of economic growth on record. It has heightened risk perceptions and exacerbated financing gaps, especially in low-income and emerging market economies. The high costs of these negative spillovers are falling disproportionately on countries that have limited fiscal space. As a result, Africa slipped into its first recession in more than 25 years, with the sharp tightening of global financing conditions triggering sudden stops and massive capital outflows from the continent, alongside one of the most dramatic global demand and supply shocks on record. Now, these events have intensified liquidity constraints, compounded existing macroeconomic management challenges, and undercut investment. Now, joining me to look at the effects of global interest rate hikes and the U.S. credit rating downgrade on African economies is Benjamin Boachie. He's chief economist at SecondStax. Benjamin, it's good to see you again. Thank you so much for joining me on Business Edge.
Hi, thanks for having me.
So recently we saw interest rate hikes making waves, of course, across the globe. And in the U.S., we saw what the interest rates rose to at the time that it rose. And we've also seen the U.K. and a number of other countries also follow suit. Do you see these interest rate hikes as something that are going to continue in the near future? In the U.S., it was a robust 2.4% for Q2, and that led the Federal Reserve to raise rates about 5.25% to 5.5%. Then that's the highest in 22 years. Europe's ECB also lifted rates to 3.75%. We've also seen in Ghana, particularly, the policy rates rose 50 basis points to 30%. And even with Nigeria, rates were raised to 18.75%. And that's for a persistent inflation in the past 1 or 2 years. What do these moves really tell us? What do they reflect currently?
Sure. Yeah, the inflation picture across the globe has been trickier to solve than I think most of us would have hoped. So we're going to have to continue to see rate hikes, which will continue to increase the cost of borrowing for consumers and folks around the world. But it needs to be done, because the most important thing that we want to avoid is a scenario where the market's expectations for further inflation get out of control, because that becomes extremely difficult to rein in. So you're seeing that in the U.S., they're raising rates. Their last inflation print was in the wrong direction. So I would expect that the Fed will continue to raise rates over there. In Ghana, it was a very similar situation. On the margins, the inflation print was in the wrong direction. I think it was up about 60 basis points. And so again, they're going to have to continue to raise rates. It's painful medicine, but it is necessary. And we're going to continue to see that in the short to medium term.
So painful medicine, but necessary. So let me follow up with that, because most economies across the world have followed in the footsteps of the U.S. And there are concerns about whether or not these interest rate hikes are actually yielding the results that central banks have been looking for. And I've spoken to a number of economists, and some have said that this is a typical tool, that is raising interest rates. But this current situation is not that classic scenario. It's not that classic equation. Right. You can plug in raising interest rates and you can click your fingers and get the automatic decrease that you want in inflation. So what do you think about using this as a tool as it is right now? We've seen Japan as an outlier, which has actually refused to follow the global trend. So has this tool really worked the way central banks would like it to work?
Right. So those are two very good points. One, this is not your classic scenario where inflation is just going up because of an increase in demand. A lot of it was the result of supply chain issues that occurred during COVID, and they're just lingering. But as it turns out, interest rate hikes are pretty much the main tool that central banks have to fight this type of inflation. They don't really have too many other wonderful tools that at their disposal. In the U.S. and in Japan, like you mentioned, they've got a bit more leeway and a stronger central bank, larger balance sheet, so they can do some more interesting quantitative tightening and easing as needed in their fight against inflation. But here on the continent, raising rates is pretty much the primary tool at their disposal, and they're going to have to continue to use it until we get it under control. In terms of what we're seeing by way of success in the U.S., I mean, inflation peaked, around 9% and is now down to the 3% range, which is close to their target of 2%, but it's still outside of that window. So they're going to have to continue to push on the rates. On the continent, inflation has been way more stubborn. In Kenya, though, you do have a bit of a bright spot. The central bank was recently able to bring inflation rates to within their target
range.
So there is some success, and generally the trend is moving in the right direction. It's just, like I said earlier, painful medicine that we need to continue to take in the short to medium term to finish the job, because you just don't want those expectations to get out of whack, because that becomes reality and that can really wreak havoc on the economy.
Very true. So what we've also seen as a consequence of this is there have been many African downgrades in the past 2 or so years. And let's look at the big African economies now: Nigeria, South Africa, Egypt, Kenya. One would even have to ask, have those downgrades been fair? And Benjamin, I ask this because we know that Ghana's finance minister, Ken Ofori-Atta, has been very vocal in the past few years. And he thinks that the ratings agencies, the big threes, don't really understand how African economies work, some of the pressures that are probably more localized when it comes to our economy. So do you think that these downgrades have been fair in the past few years? And is there a case to be made for adjusting how Africa is rated when it comes to credit ratings and interest rates and things like that?
Yeah, it's a good question. Generally speaking, the way the global financial architecture was developed and built over decades didn't really include input from Africa. So I can totally empathize and sympathize with the idea that it might seem unfair, but I also don't know that a bank, for example, would give you credit because you say that you've rated yourself, right? They have to do the rating so that they can decide how they feel about what they want to do in terms of lending and your creditworthiness. The real solution needs to be domestic. On the continent, we need to work together to have more intra-Africa trade, right? More African output. We need to develop our capacity here on the continent. So in that sense, it really shouldn't matter as much. Whatever the rating agencies in the West say, that just shouldn't matter as much, because we have a more robust domestic economy and financing architecture that we can rely on. So that's the direction I would go in. And I really don't know that the conversation about whether their ratings are fair or not is really a direction that's going to get us where we're looking to go.
Okay, so let's talk about another major downgrade, and that is, of course, the ratings agency Fitch downgrading the U.S.'s credit rating from AA+ to AA+ from AAA. And Fitch cited fiscal deterioration over the next 3 years and also repeated down-the-wire debt ceiling negotiations that would threaten the U.S.'s ability to pay its bills. This is the world's largest economy. So in a way, whatever happens there will have some level of ramification or consequence around the world. So Benjamin, what is that consequence? Even though the U.S. was not happy with this, a deal had been reached about the debt ceiling, but this is Fitch almost predicting a continuation of whatever these situations would be. So for the rest of us, what's the impact of this, particularly on African economies?
Well, it shouldn't be too pronounced, largely because the markets more or less waved off the downgrade. We've written extensively about this here at SecondStax. The U.S. downgrade that happened, last week or the week before, and the one that happened in 2011 were both the result of political risk. These are issues where the politicians, the people governing the country, just simply refuse to get along and refuse to do their part, to move their debt ceiling and pay off their bills in a timely manner. That is a factor that is also happening on the continent. In Ghana, when Ghana defaulted on its debt, a lot of it was because Parliament and the executive couldn't come to terms on how to forestall that type of a calamity. So the main reflection that I see on the continent for what we're seeing in the US is that we need to take in the lesson that governments must work together. Whether you're in opposition or you're in government, you must work together. And if as an opposition party, you're going to hold back your president from, or your finance minister from doing what they need to do simply because of politics, that the impact is going to be, you're going to be punished in the markets by way of downgrades and ultimately defaults if you really are unable to get ahead of your issues. So that's the major takeaway I would say.
All right, very quickly, because of time, Benjamin, I'll need to see if you can do this in 1 minute, but a point we need to make here. So over the last decade, African capital markets have raised more than $246 billion in debt capital markets. More than $87 billion has also been raised in equity capital markets, and equity indices have peaked at over 50% growth across major regional exchanges. But despite having some of the best performing stocks and bonds globally, Africa's exchanges are largely inaccessible to investors outside the jurisdictions where they're listed. So very quickly, maybe what comes to your head, the top 3 strategies that we have to employ, that our exchanges need to employ when it comes to being able to bring in foreign investors, investors from outside the locality, the physical locality of these exchanges. If they're doing so well with these constraints, imagine what they can do when the constraints are removed.
Sure. And, there's really one major answer, and that's SecondStax. What we do here at SecondStax is we connect the capital markets across the continent. A huge part of why foreign investors have issues, targeting Africa is because the capital markets are siloed. They're small. They don't necessarily trade. They're not as liquid. Once you bridge all of the capital markets on the continent, like you said, you just rattled off the numbers, we will see a pretty dramatic shift and onboarding of capital onto the continent, because all of a sudden you have one unified, deep, liquid market that can provide you returns in so many different ways. So yeah, we're very proud of what we're doing here at SecondStax to bring this unified capital market to the world.
And I know that's going to be a further conversation for another time, but Benjamin, I have to let you go. Benjamin Boachie, Chief Economist at SecondStax, thank you so much for joining me on Business Edge.
Thank you for having me.
And conversations today looking at the CBN's audited financial statements that came out, and of course a lot of questions that will continue into the coming days, and also looking at the interest rate hikes and the impact of the U.S. credit downgrade on African economies. These are conversations that continue over time, and you can trust that right here on Business Edge we'll put finance, economy, and of course business front and center. At 12 p.m. West African time, you have News Central Now coming your way. I'm Tolulope Adeleru-Balogun. Until next time.